Hello, and thank you all for joining us at today's Q4 market update. Today, you'll receive information on an economic outlook, 4PL trucking update, and procurement trends. We encourage you to ask questions throughout today's webinar. You should see a little question box on the side of your screen. Feel free to put your questions in there, and we will address all questions at the end of the webinar. As a thank you for joining us today, we will also be sending you a full copy of our market update report, which does include in-depth information on other modes and trends. So we've mixed it up today for our speakers. Things might look a little bit different. I'd like to introduce you to Nathan Adams, who's our VP of Procurement, Mazen Danaf, who you should be familiar with if you've joined us before. He's our Senior Applied Scientist. And then new today is Russell Zupo, who's our VP of Consulting Services. And then I'm your moderator for today, so I will be introing and helping to moderate any questions at the end. So on that note, let me turn it over to Mazen Danaf, who will go through an economic outlook with us.
Thank you, Rebecca, and good morning, everyone, or good afternoon. So I'll be going, as usual, over the economic outlook of the goods economy, what's happening in the broader economy in terms of spending on goods, manufacturing, and wholesale activity, and how does that affect the trucking market, and as well covering some supply trends in the trucking market as well. So this is all based on some external data, and then Russell later will be going over our internal data from the Uber Freight platform. So starting with the first topic, consumer spending on goods. This chart shows how much consumers are spending in real dollars on goods, and by real dollars, we mean this is adjusted for inflation. So this is the closest we can get to the actual volumes of goods moving on trucks. And we can see that spending on goods has surged after COVID. It has stagnated for a year and a half or 2 years after 2021, going into 2022. And recently it has started to increase again. Now this was driven mostly by durable goods, motor vehicles, some groceries. So it wasn't uniform across all sectors, but still we have been seeing some 2%, around 2 to 3% increase year over year in total spending on goods. So as I said, spending on durable goods is up about 5% year over year, while spending on non-durable goods, which are things that we consume on an everyday basis, like food or apparel, it's weaker. It's about 1.3% year over year. Now, despite this positive trend of 2.6% year over year in the last month, this is still weaker than the historical growth that we have seen in the years prior to COVID, where spending on goods was growing by about 3 to 4% year over year. Another thing to note here is that consumers have been saving less in order to maintain these high levels of spending. So we see that real incomes have been decreasing due to inflation. The saving rate has been decreasing because incomes are decreasing, so consumers are still saving less in order to spend more. And whether that's sustainable or not, we have to see until what happens next year. But in my view, we might not see the 3 to 4% historical growth rates next year that we have seen prior to the pandemic. So if spending on goods is still relatively healthy, then where is all the freight demand? This explains part of the story. This slide shows real retail, real wholesaler sales, and wholesalers' inventories. So wholesaler sales are shown in blue and inventories are shown in black, and both of these are, as usual, adjusted for inflation. So these are real sales and inventories. And we can see that sales have been stagnant for the past 2 years. They peaked around January 2022 and they fell since then. They bottomed around April of this year, but after April, we have seen 5 months of increases. So real sales, real wholesaler sales have been increasing for 5 months, which is a positive sign for the economy. Now, this is also not uniform across all goods. We see it concentrated in a few sectors, particularly motor vehicles, groceries, and drugs. So these are, for motor vehicles, there's a lot of pent-up demand. For groceries and drugs, these are things that people need on an everyday basis. So they're not very sensitive to economic downturns. But still, the 5-month increase is a positive sign for the economy. On the other hand, we see that inventories are starting to decrease or starting to normalize. They peaked around December of last year. we have seen a huge increase in inventories in the prior 2 years. And then for the last year or so, inventories have been decreasing. This means that wholesalers as well as retailers continue to control their inventory levels. They continued in the destocking process. And still, inventories are still high relative to sales, but they are trending in the right direction. Now, some sectors have higher inventories. Some sectors are still adding inventories, especially the motor vehicle sector and the machinery sector. There is some pent-up demand in these two sectors, while some other sectors still have high inventories. Particularly, we focus on furniture or apparel, appliances, alcohol. So these sectors have high inventories relative to sales. And we still hear from some of our customers that they have high inventories levels, maybe for like 2 or 3 years worth of inventory in their stocks. So the high inventories have caused some recession in the manufacturing economy. This slide here shows the Institute for Supply Management, or the ISM PMI, the Purchasing Managers Index. So this is a survey-based index that tells us how the manufacturing economy is doing. And the way to interpret this index is that any value above 50 indicates expansion, and any value below 50 indicates contraction. And when we look at this chart, we can see contraction across the board almost. So the PMI, which is the aggregated index, is below 50. It has been increasing recently, but it fell in the latest month. It means that the manufacturing sector has not found the bottom yet. When we look at production, it's fluctuating above and below 50, so production more or less has been flat or slightly decreasing. Backlogs are shrinking, new orders are shrinking as well, so they're lower month over month. And this means that the manufacturing economy we might still see contraction in the months coming ahead. So backlogs and new orders, I look at them as early indicators of the manufacturing economy, and both of these are pointing to more contraction ahead. And the good news in this data is that the prices has been below 50. This means that raw materials prices in the manufacturing economy have been decreasing. This is a good sign on the inflation front. So that's all on the demand side. Now shifting to the supply side. This chart shows trucking employment in blue. So this is total trucking employment across various trucking sectors, including dry van, reefer, flatbed, bulk, like all the trucking economy. And this is focusing only on payroll trucking employment. So it excludes private fleets and it excludes some owner-operators, depending on how the company is registered. The line in black is a subset of that trucking employment, and it shows long-distance truckload employment. So this is where we're looking at the right axis. It's about a third of total trucking employment, but it is more relevant to the truckload market, and particularly it's a strong predictor of spot rates. So when we look at trucking employment, the blue line, we see that it has increased a lot in the past 2 years. It flattened out, and then we had this sharp drop. So this sharp drop was due to the yellow bankruptcy, which we saw 2 months ago. Since then, employment has turned negative year over year. Right now, it's about negative 2% year over year. And this is after a long streak of positive year over year observations. When we focus on the truckload sector, however, we haven't seen such a significant drop. It is still about 1% negative from its peak, 1% lower from its peak. And the peak was just observed in May of this year. So even until May of this year, despite the soft market, carriers were still adding employees to their long distance fleets. Now, do we expect this to continue forward? Maybe not, so for a couple of reasons. The first reason is that a lot of this employment has been reallocated capacity instead of added capacity. So these are carriers that smaller carriers who failed or exited the market, even owner-operators that are not captured by this data who exited the market, and they were absorbed by larger fleets. And these larger fleets might not be able to absorb this excess capacity yet because of weaker demand and because they're getting saturated. So this chart here shows the same data, long-distance truckload employment shown in black, but I'm showing the year-over-year change here. And in blue, I'm showing the year-over-year change of DAT contract rates, the average contract rates across the whole US. And what this is telling us is that when contract rates decrease, so this is lagged by 10 months. When contract rates decrease, we expect a decrease in trucking employment as well. So we expect a supply correction as carriers' revenues decrease and as carriers' margins increase. And this is what we've been seeing recently. So we saw that contract rates have been falling. They're about negative 20% year over year. And if the historical trend continues, we expect trucking employment or long distance truckload employment to fall by about 3 to 5% over the coming months. So this is all on a year over year basis. If this happens, we expect this to have a significant impact on spot rates. My estimations indicate that a decrease of 3 to 5% in employment will increase spot rates by about 15% to 25%. So this is the last chart I have. It's actually not the last, but it shows new carriers entering the market and carriers exiting the market from the FMCSA data. So when you look at the line in blue, it shows new authorities granted by FMCSA for tracking carriers, regardless of the size. And the line in black shows the revocations, or carriers exiting the market or losing their operating authority. And what we see here is that we have seen a huge wave of new carriers entering the market in 2021, going into 2022. And then recently, this has been receding. And we have seen a wave of revocations, carriers exiting the market because they were getting squeezed between high operating costs and low spot rates. So a lot of carriers could not survive this market. And for the past year, revocations have been outpacing new authorities. So we've seen a net reduction of the total number of carriers. The total number of carriers in the last year has been about 90,000, and this has resulted in a 20,000 net decrease in the carrier population. And there's still a lot of way to go until we reach normalization, but this has been a continuous process for the last year, and this also indicates that supply correction or capacity correction is underway. Now, this is my last slide. It shows how carriers' operating costs compare to spot rates and contract rates. So I showed the carriers' operating costs in red. This includes all the operating costs per revenue mile. So this is adjusted for the empty miles, and it includes the total operating cost of the tractor depreciation, trailer depreciation, fuel, maintenance, all the marginal cost of operating the truck. And we can see it is significantly above spot rates. It's about 16% or 17% higher than spot rates. And it is approaching contract rates. This means that almost every mile driven in the spot market by carriers right now is a losing mile. Carriers are losing money on the spot market. And in the contract market, most carriers are barely making enough money to cover their expenses. This is consistent with the latest earnings reports we've seen from carriers, where the operating ratios have decreased from about 10%, 15% to low single-digit figures in the latest quarter. So that is all on my side, and I'll hand it over to Russell to go over some 4PL market trends.
Thank you, Mazen. I'm going to double-click into some trends from data derived from our managed transportation business. These charts go back 4 years, so we get a good year-over-year comparison, and they're made up from data from hundreds and hundreds of shippers shipping billions and millions of dollars of freight. And this is dry van only. So dry van is pretty representative of reefer, and it has really good volume for statistical confidence here. So what we can see here is, route guide compliance and primary tender accept are just high throughout the year, right? So we started the year very high. We've remained very high, and we've had very little seasonal impact. Normally, we expect to see something in March, in the summer, and maybe September. We've had maybe a small dip in September, but really not a lot of impact from seasonality, just very high with the oversupplied market. Likewise, the inflation over primary is very, very low. So if there's not a lot going off the primary carrier, obviously there's not going to be a lot of inflation. But even sometimes when it goes off the primary carrier, we're seeing obviously it's going to be a cost savings or a deflation versus an inflation. This next set goes into explore a little bit of our 4PL service trends. So the first piece that I like to look at is our lead time. So this is basically between the time we have when an order becomes a shipment order and we receive it till it has to ship. And, we started the year off interesting in that we were kind of in the pack and we were just following the seasonal trends through the year, but we sort of outpaced previous years here. And, generally spikes or dips in demand cause uncertainty and they can reduce lead time. So I think what we're seeing here is a lot of shippers are sticking to plan and they've got a good plan right now. But 9.5 days about is a really solid lead time. We're also seeing accessorial percent of spend drop significantly through the year. So, as volumes are lower, you obviously are going to have less accessorials because there's less things like wait time for carriers on the yard and things like that. But, also as shippers have, hit the bottom of cost, they're starting to look for other ways to save money and starting to maybe focus a little bit more on accessorial reduction as well through continuous improvement initiatives. And then the last thing is service to the customer, right? So that we use this relative MABD index, and you can see that is consistently high throughout the year and with very little dip. So service is significantly better, and we don't see that stopping anytime soon. This next set of charts goes back 2 years only, and it breaks down equipment and mode for some of the things that we've talked about. And so it's very busy, I know, but there's 4 columns. One's for dry van, reefer, flatbed, and intermodal, and some comparative charts across the rows. So the first 2 rows of data also are relative. So they're actually relative to 6 months ago, so April of 23. So it's how much are we inflating or deflating compared to April of 23. It's just sort of an arbitrary point. It's as we display these charts, we move it along with the data. So in the top row, we're looking at contract and spot inflation or deflation here, and that's all relative to the contract market price. And so you can see across all modes, rate pressure continues. So there's a nice significant anywhere from 13% to I think 7% gap between contract and spot on all modes. And then, intermodal is a little noisy. We don't have a lot of spot intermodal, so I don't know if that's that little blip at the end there where we're exceeding the contract rate is real or just the nature of the data because it's noisy. Also, total inflation, another relative trend. Interesting thing with the total inflation is that compared to 6 months ago, total spend for shippers is about the same across the board, with the exception of dry van. So dry van, which is, again, the biggest mode that we see, hasn't really recovered from the summer lows. And there's really 2 reasons for that. The first is that, well, really 1 reason, sorry. The reason is that shippers are using a little bit more spot, whether it's through brokerages or through auction, to drive prices down right now and drive in. So you can kind of see that too in the chart below where we look at the spot auction percent. So it shows there as well. I think if I had a chart here showing broker usage as well, it would show in that. And it's just kind of hedging a little bit where you don't have the high need of service to take those lanes and maybe reduce cost a little bit to continually hit savings targets. And then, as we mentioned before, first tender acceptance, it's just high across the board, right? So I don't see any issues or variations across mode there. And I don't have a slide for this, but I want to provide a little insight into what kind of projects we're seeing in consulting services as well. So right now we have an uptick in efficiency projects from network optimization, a lot of dedicated fleet and private fleet assessments, and then we're also seeing more inbound assessments too. So really shippers are starting to turn their eye to find cost savings in areas where maybe they don't look at as much as other areas for efficiency. So that's my update on 4PL and consulting services. I'm going to go ahead and turn it over to Nathan Adams to talk a little bit more about procurement.
Sure. Thanks, Russell. So what I plan to do is just covering a little bit through what we see at the procurement side of the house, along with just some carrier sentiment, along with some potential best practices we can look at 2024. Really trying to wrap up what Mazen and Russell said. There's a lot of good data out there. And so what does it mean, right? So what does it mean to our business? You think of procurement and I'll explain this. I understand there's not the axis is on there, and we took those off just because everybody's baseline is a little bit different. But what your black line is, and so if you think you go into a typical RFP, a large, robust RFP project with many scenarios, the black line is where you sit in that first base feasible scenario. So it really is just take into account the cost and the capacity that the carriers provide you. It does not take into account any facility constraints, anything else around spend you want with certain carriers or categorization of carriers. And so that's really just your baseline. Probably not a feasible solution, right, on your very first scenario you run in an RFP event, but we like to put a bookend on it and say, okay, so how deep do we go through the scenario management piece of the world? So the blue line is where we're actually landing. And on the next slide, I'll go into a little bit more about how many events we do, but we do several hundred a year. We have a really good viewpoint of kind of across all the different modes where things are landing. This is just truckload. But what I wanted to talk about on this slide is just as you've seen, going into the end of 2022 and throughout the year, that gap is starting to widen, right? So from the base scenario to where we land on a final scenario, the blue line, we have a larger gap than what we've seen in the past. And so what we're seeing in these bids is that shippers are starting to leave a little bit of savings on the table. I think in 2022, a lot of shippers went after the heavy cost scenario, really started to bring some new players into their network. You saw all the capacity that had been added into the marketplace that Mazen had showed in some of his slides. So a lot of folks are going in and saying, hey, I can go and get some savings. I had a rough year in 2021. I got beat up by my CFO. I'm going to get some dollars. And a lot of shippers did. And that included bringing in a lot of new carriers, a lot of new entries to the market, a lot of new brokers. What we're seeing now is that there's still savings on the table to get during these procurement events. And I'm talking truckload mainly. But shippers are saying, hey, I don't want to go with the new entrants. Maybe I went a little too deep into the brokerage world. Maybe I went a little too deep with new carriers. And they're selecting more asset-based providers, more core players to their business. And so that naturally is going to widen that gap between what we're seeing from a price standpoint and what we're seeing from where we land in the end of the scenario. So just some headlines to kind of go with that trend, right? So we've completed already 189 RFPs this year in our organization, and these are only these are the large, robust optimization I'm talking about when I say what's a project, what's an RFP. Well above what we're doing from last year's standpoint, and we continue to have record years in the space. So RFPs are still happening. I think there's a lot of questions on is the RFP, still a viable solution for a lot of networks, and obviously it is. There's just a little bit different spin on them now versus where we may have seen in the past, where it was a sit it and forget it. See you in a year, we'll pick up the project again, start pulling some data. This is more of how we maintenance things throughout the year. Do we do multiple RFPs? Do we do seasonal RFPs? And so we see a lot more maintenance of the network throughout the RFP cycle versus just I'm going to put my stuff out to bid and then I'll see you in a year. We're starting to see that LTL is ramping back up. We had the big Yellow bankruptcy that we were all impacted by, and that really put a lot of the LTL networks in uncertainty. I think Mazen hit on the driver moves as a part of that, and where drivers are going to land. There was capacity in the LTL world, and since then with Yellow leaving, it's interesting. There's probably about a 10% amount of capacity open in the LTL industry in the U.S. and Yellow leaving pulled 10% out, and we're pretty close to equilibrium, right, in the LTL world. And I think a lot of folks saw that as things got tossed up in the air. Yellow gave back a lot of freight, or we stopped shipping with them. Where did that land? And so there was a lot of talking through pricing, talking through where we are with the LTL carriers, and until a lot of that capacity landed, which it has. And I'd say we're sitting at kind of an equilibrium, right? And so when I showed that previous slide on truckload, and there's still some rate savings out there, maybe not as much on the LTL side because that network is pretty full. So as we start to see upticks in the market, through the back half of the year next year, we'll continue to see some price pressures in that space. I touched on this a little bit just around like what are we seeing strategic trends in the market. We're seeing a lot of emerging trends to, hey, we're going to RFP, but we're only going to bid out of cost market lanes, or where maybe I don't have a great servicing provider on that, or I have an operational change. I'm opening a new facility. I have new shippers. So we're seeing the networks being carved up a little bit to where if I have good service, I have good carrier base on the front end, maybe I do some offline negotiation on the front end and not take that step to RFP, just based on everything we've been through with the carriers and the up and down years over the past 2 or 3 years. A lot of folks are starting to decide maybe we can really sink into our partnership with some of these carriers and bid some of this or negotiate some of it on the front end and take the stuff that makes sense out to RFP. Really starting to get smart in our networks about how do we segment everything and how do we look at different, different requirements by customer, different requirements from the shippers or receivers, and retailer ABC may have a certain threshold of service they're expecting or MMBD versus another. And so we're seeing a lot more scenarios to where we're seeing a shipper or a receiver specific scenario where customers, instead of solving the whole puzzle, they're trying to solve pieces of the puzzle and bring it back together. So a lot more details in the network than potentially just, again, putting the large bid out there, getting the pricing and moving on. So a lot of good details that we're seeing from our customer and our RFP projects. And again, I think the previous chart showed this, the shippers are starting to inflate themselves a little bit ahead of what they see as a upturn in the contract market. And kind of all signs are pointing to that between the employment data that Mazen showed, a lot of the data that Russell showed, and the capacity correction, I think we all agree is probably taking place right now just with the exit. So shippers, again, they're picking asset-based providers. They're still picking brokerage where it makes sense, but really leveraging their strategic partners when they are going brokerage and not using a new entry to the market just to go and try to save price. From a carrier standpoint, we still continue to see a lot of bids from the truckload carriers. You can track this as well. During tight markets, carriers bid less on less percent of lanes. Right now, a lot of the carriers that are bidding on as many lanes as they can, bidding on most if their network can handle it. And we see continued aggressive pricing from brokers. I think a lot of this is, as cost pressures mount and carriers start to leave the marketplace, everyone's trying to capture as much freight as they can and continue to be aggressive. Even potentially having lost leader lanes with some of the brokers just to continue to have business flow and create cash flow and so on. I'd say from a pricing standpoint, still very much in the low, double digits. It should be single digits, the mid single digits. And as I touched on the LTL side, rates are going to start increasing as that network fills up and we continue to reallocate freight with that bankruptcy of Yellow and that freight that's moving out, or the capacity that's moved out of the marketplace. So lastly, I just wanted to cover some of the best practices we're seeing and we're recommending heading into 2024. So it's a really great time from a carrier management standpoint to establish your strategic relationships with key providers in your network. Get close to your partners that have really taken care of you over the past few years, and work with them on what does it look like to create mutually beneficial agreements, longer term goals. Not saying you need to lock into longer term contracts, but really going down with your core carriers and looking at long term plans. What are they going to do in their network? What are their initiatives on technology, best practices? How do we really partner and become, develop these strategic relationships to try to take some of the peaks and valleys out of the market, right? So, how do you work with your carriers now to, pay them an adequate rate when the market picks up, but not just, be to the winds of the market, right? And so that takes a lot of the work in the downtimes right now. And so right now is a great time to do it after we get through peak and starting to regroup with your carrier base. I mentioned, establishing pre-bid commitments with your carriers. If someone's servicing something well, they're a strategic partner for you. Their rates are in line when you benchmark it. It makes sense to probably reach out to them and understand, hey, how can we extend this into the future? How can we really make this solid through the next bid cycle as part of that long-term planning and your long-term goal setting that you work on with your carrier base? And of course, develop a formal process. It's also a great time to really address service issues, capacity, commitment issues. Am I getting the trucks that you said I would get during the RFP? Am I getting them at the service levels? Am I getting them at the cost levels? And start to develop that formal process, develop improvement plans, and really work with the carriers, not only dig deep into the strategic relationship, but then also hold them accountable for the service now to put all that rigor in place as we head into a tougher market. I think there's going to be a lot of volatility, and we all know that. We've been living through it, especially since we're all supply chain professionals. It kind of comes with the territory. But I start getting, understand what your carriers can do from track and trace. Meet carriers where they are in their tech journey. Some carriers are going to be fully ready to sync up API directly to your system. Some are maybe not even down that roadmap of planning to do APIs, and they're still heavy EDI users. But meet carriers where they are, really push into the track and trace world. Again, going back up to the top, develop the formal processes. Understand where your rates are. I think it's always a good time to benchmark your rates when you're in the middle of an RFP process. But then again, work with your carriers, understand their understand their network, understand their cost pressures that they're running into, and really work and try to build out some cost and price transparency within your network with your carrier base. So again, very, very heavily themed on the relationship side of the house and working to get things in place from performance planning, just long-term goals. Then how do you work with your carriers to get through the market? And that's kind of how you will lead to a more stable network that will obviously still see some hiccups in as price and capacity tighten up, but this will get us in the best position, and then you'll be able to have those difficult conversations by doing the groundwork now. Okay, I think I will mention, I don't have a slide specifically on just carriers, but we've had conversations with a lot of our truckload partners throughout normal PBRs, and I'd say they are also under a lot of cost pressure. They're under pressure to replace equipment that is aged, they may be deferred maintenance on. And so you can tell rates are depressed, but costs are mounting. And so they are looking, once the market turns, to be able to get rate back into the conversation. So I think that makes a lot of this that's on the slide even more pertinent to our business. I think that's my last slide, Rebecca. So I will hand it back over to you at this point.
Okay, great. Thank you all so much for all that information. We've got a lot of great questions to go through. Again, if you have any questions from today's webinar, feel free to just put them in your little question box and we will try to get to them. All right, our first question, I'd like to also invite all three presenters to come back on camera. We can see you. All right, first question. This is going to be for either Mazen or Russell. I think Mazen. What benchmark guidelines or data do you have for manufacturing supply chain cost or freight cost as a % of sales?
Russell, do you want to take that?
I'll go ahead and grab it, yeah. So, I mean, obviously there's a lot of variables there. Depends on industry, depends on your international to domestic mix. But when we've done this in the past, it's always been sort of one-off consulting projects to sort of bench you against like companies. So, there's some rules of thumb out there for domestic and international, and just, again, depends on your industry and mix. So generally it's one-off.
Okay, thanks. And also friendly plug for our consulting services that we offer here at Uber Freight, led by Russell and his great team. Feel free to follow up with us if you have any needs for those. All right, just kind of a general question, and really, I think this is going to go back to Russell too. Where can we find the definition of the various terms like first tender acceptance ration?
That's a fair call out. We did not define those very well for you on the slide, and I don't think when we hand out this deck they're defined well either. But I mean, obviously, route guide compliance is when you contract carriers, you have them on route guides by lane, and typically we're just looking at how often we stay on the route guide. For first tender accept, it's actually just as it sounds. It's as you're going out with a load, it's the first carrier that got tendered on the route guide. Did they take it or not? So it might still stay on the route guide, but maybe the first carrier that had an option to take it chose not to. And that's a little bit more like, it's a little closer to a primary carrier acceptance than the route guide is. So we look at both of those, and primarily we look at those because a lot of our shippers have different rules around route guides. So those are the two that give us the best sense of performance.
Okay, great, thank you. All right, another question for, I think, Mazen. What do you see the long-term impact of Panama Canal drying up on the trucking market?
Yeah, so I can speak a little bit to what we have seen so far. We have seen a very limited impact on the truckload market in the US. We have seen some impact on imports. We have seen imports shifting back from the East Coast to the West Coast, reversing the trend that we have seen in the last 2 years. So we expect this to continue, especially with the Panama Canal issue. But when we think about imports, why am I saying this is a limited issue? It's likely to affect the intermodal market more than the truckload market. So when you think about imports, we think about the first access point, and that's whether these containers will go on a truck or an intermodal line. Obviously, the West Coast will favor more the intermodal rail lines, especially for like these lanes like Los Angeles to Chicago, and Long Beach to Chicago, and so on. But the other issue with imports is that their effect is not only limited to the first access point, but also what are we importing? So most of the goods that we're importing are either capital goods or industrial supplies, and these are used in the production of in manufacturing, in the industrial production, etc. So that's why, regardless whether we see like a small increase in imports on one coast or another, just the imports themselves, the higher imports will mean more freight, and we're currently seeing higher imports in the last few months. So I would say it's a very limited impact on the truckload market, a positive impact on the intermodal market in terms of volumes.
Great, good to know. Nice to have a positive outlook every once in a while. All right, Nathan, when would it be a good time to initiate an RFP for LTL in 2024?
Yeah, I think there's a lot of factors there, right? And happy to talk a little more offline, but in general, right, we're going to see a lot of bids coming out in Q1. I think there's another question on here just around the Yellow bankruptcy, Rebecca, that I can kind of weave into all this, right? I think with Yellow going out of the U.S. network, there definitely was a disruption, but I'd say there's enough capacity in the U.S. LTL market to kind of absorb Yellow, per se. A lot of those drivers have started to land in other places, even on the truckload side or other LTL carriers. A lot of the freight has found homes. And so I think part of the question is with them moving, what do we see for rate, right? And I'd say we're probably at kind of the equilibrium of a supply and demand world in the LTL side of the house. So as anything starts to pick up in the economy, it's going to put pressure in that LTL network. I would say, if your bid cycle is coming up in Q1, it's probably a good time to hold with that bid cycle and go ahead and get rates established with your carriers. Like I said, any disruption in that network or increases in demand is going to start driving that price up just because we're going to run out of supply. And the carriers are going to start making choices on yield and what they take. So I'd say we're in an okay spot now. We're probably at equilibrium. Back half of the year is predicted. We're going to start seeing some additional increases based on if any freight picks up and not having any additional LTL capacity with Yellow's exit. There's probably some stabilization factors to figure out if whoever takes pieces of Yellow's network, what they do with it, if they stand up full terminals or not, and how much capacity comes back in. But right now, we're just kind of thinking of it as we're sitting in equilibrium. There's no major terminals going to come into the network at this point. So from a RFP standpoint, I'd say go ahead and it makes sense if your cycle started in Q1, go ahead and do it in Q1. If your cycle's later in the year, it's probably worth looking at the factors in your network, looking at working with your trusted advisors, and how can we pull that back up in the network a little bit based on your carrier base and your volume.
That's great. And I do want to share too, we've got some information on Yellow and kind of the impact that it has. We will share that in our deck that's being sent post webinar.
I can talk about this a little bit also. So I have a slide on that.
Perfect. That's the
Yeah,
one.
this slide shows what was the impact of the yellow bankruptcy on rates and then unemployment in the LTL sector. So when you look at rates, the chart on the left shows the PPI, the Producer Price Index. So this is a measure of prices, including fuel in both the truckload and LTL. So showing truckload in blue and LTL in black. And this shows that truckload prices have been decreasing for the last 2 years or so, while LTL prices after the yellow bankruptcy, they started to increase again. They're risen by about like 5 to 6%, I think, based on this data, but they're still below the peak. So they still haven't fully recovered to where they were in early 2022. So even with the yellow bankruptcy, we haven't went back to the tight market that we've seen before. But at least it ended the LTL recession. So one of the trends that we've seen in the past 2 years as well is that with the softening in the truckload market, we've seen a lot of volumes shifting from intermodal and LTL to the truckload market, which became much cheaper. So in terms of volume, the LTL and intermodal markets lost more volume to the truckload market. And as the truckload market starts to tighten again, we expect the opposite to happen. So we might see more volume shifting back to the LTL sector. And with the yellow bankruptcy, we might start to see prices picking up again next year, as Nathan was saying. So the chart to the right shows employment, a huge drop in LTL employment. So this is just like what's happening with yellow. But in terms of the truckload market, we didn't see any effect of the yellow bankruptcy on the truckload market. One of the interesting things I look at is the work hours per week. So how many hours do drivers work per week? Historically in the LTL sector, it used to be 42, 43 hours. Just before the yellow bankruptcy, it was about 38 hours. So there was a lot of idle capacity there. And after this yellow bankruptcy, it rose to about 39, 40 hours, but it's still lower than the historical average. So there is still room for extra capacity. There's still some idle capacity, but it is tightening.
Okay, great. And we will be sharing that with you after this webinar. All right. Not sure if we have access to this data, Mazen, but have we seen a reduction in driver salary, and when might we see that impact rates?
Yeah, that's a great question. So this data is public, so it's shared by the Bureau of Labor Statistics. You can access driver salaries or wages by different sectors. I think the most relevant sector, as I've discussed, is the long distance truckload sector. We have seen a reduction in wages of about 4% in the last from its peak. So the last observation was 4% lower than the peak, and it has been decreasing in the last few months. This relates to what I was discussing before, that carriers have less appetite for hiring with the soft market, and they're getting saturated. They're losing some money, especially on the spot market. Even they're not making enough margins on the contract market. So there is less appetite for carriers to hire and more appetite to cut their capacity. So this is one of the early indicators as well that we might be heading into a capacity correction over the next few months, which will definitely increase rates.
Okay, great. And then on that same note, so with the predicted upturn in rates, will this rise in rates be driven more by demand or reduction in capacity? So if there is a turn in the economy, will capacity reductions still support increasing rates?
Yeah, I can take the first shot at that. So I think we're looking at a few forecasts, and most of these forecasts are predicting about either high single digits or low double digits increase in spot rates over the next year. And they're motivated by different factors. I would say our forecast is motivated by a reduction in capacity, especially a reduction in trucking employment. So we might see some either layoffs or bankruptcies, carriers exiting the market over the next year. And that is the primary driver of our forecast, why we expect spot rates to increase next year. We're looking at other forecasts which focus on the demand side. But on the demand side, we're not expecting any shocks like a stimulus or a lockdown like what happened in 2021. The only factor that might impact the market is the continuous destocking of inventories. So the inventory situation is getting better. But that is a gradual process. It's not like we have been seeing that for a year now, and the market hasn't really recovered. and we will continue to see that. So it is we don't expect much of an impact. I would say it's mostly on the supply side.
Okay. Well, with that, team, I don't have any more questions in the chat. Thank you all for your participation. Thank you to our speakers. Again, we will be sending you a copy of this recording, a copy of the presentation shared today, and your full copy of our market outlook that's generated by lots of SMEs in our organization. So tune in for the next one and have a great day.